Welcome to the deep dive. You give us the sources, we give you the actionable knowledge. Today, we're getting into one of the most intense periods in recent financial history, the immediate aftermath of the 2008 crisis. Our mission is to really unpack the playbook used by Morgan Stanley, one of the big Wall Street names. It's all laid out in their 2009 shareholder letter. We're looking beyond just survival here. How did they reposition?
Yeah, it's basically like a crisis management manual written after the fact, but crucially executed right in the thick of it. And the background is just wild. The letter calls 2008 a year of unprecedented events. We're talking flaps of Bear Stearns, Lehman Brothers. I mean, these huge, storied firms just gone. Massive turmoil everywhere. And then unheard of government intervention. That's the quote. The whole system was shaking.
Right, total panic. So the big question for you listening and for us today is, how did Morgan Stanley pull through? They even reported profitability in 2008, which sounds crazy. And how did they immediately set themselves up for, well, future growth? We're digging into their strategic choices, what they cut, what they kept, and where they really doubled down. Okay, let's get right into it. The crisis hits, and the letter says the firm moved early and aggressively. Sounds good on paper, but what did that actually look like? What was the very first thing they did to, steady the ship?
Well, the first move was all about discipline. Hardcore focus on leverage and the balance sheet. They knew pretty much instantly that the old ways of operating with huge debt just weren't going to fly anymore.
And the speed they moved at is pretty remarkable. Let's pause on the numbers. They'd already started cutting leverage in 2007, but what did it look like by the end of '08?
The numbers really do tell the story. It's like they hit the panic button, but strategically, if that makes sense. Morgan Stanley slashed its leverage from, I think it was 32.6 times, which is high at the end of 2007, down to a much more careful 11.4 times by the end of 2008. And the source, the letter itself, calls this deleveraging critical in navigating the most challenging market shocks. This wasn't just tidying up. It gave them actual breathing room when others were just, well, drowning in debt.
Okay, so less leverage means they needed a smaller overall footprint, right?
Exactly. The balance sheet, the sheer size of the firm's assets and liabilities got trimmed way down. It went from about $1 trillion in 2007 down to around $650 billion in 2008. They were deliberately cutting exposure to those illiquid, kind of risky assets they called legacy assets, just shrinking the risk profile fast.
But just shrinking isn't a growth strategy, and this is where it gets really interesting for me. They didn't just defend. They immediately went on offense, building up capital through a key partnership. Tell us about that Mitsubishi UFJ deal, the MUFG one, the $9 billion.
Right, that MUFG deal in October 2008. MUFG was, I believe, the second largest commercial bank in the world then. It was partly a lifeline, sure, but it was also a huge strategic boost. That $9 billion investment really shored up their capital and liquidity.
And the financial strength this created almost instantly. What did that mean for their capital ratios?
Yeah, the impact was immediate. That one investment pushed their Tier 1 capital ratio up to roughly 15%, which was
Industry leading.
Exactly, industry leading.
Okay, for listeners maybe not deep in banking terms, what does a high Tier 1 capital ratio, like 15%, actually mean practically?
So think of Tier 1 capital as the core, the really high-quality stuff, equity, retained earnings. It's the bank's safety cushion. A high ratio like 15% means they had a huge buffer against losses. And perspective here is key. That 15% meant they already met or even beat the capital levels the government would later force on struggling banks. So they were way ahead of the regulatory curve, operating from this position of undeniable strength.
And they didn't stop there. They also changed their whole funding model, right? Moving towards stability. They got approval to become a financial holding company.
Yes, the FHC status. That was a huge deal, financial holding company. It let them pivot away from relying so much on that volatile, expensive short-term market funding. Instead, they could build up a stable base of bank deposits. And by the end of '08, they'd gathered something like $43 billion in deposits. That means cheaper, more reliable funding from everyday depositors, retail, and commercial. It fundamentally changed their risk. Less like a pure investment bank, more like a stable, diversified one.
Okay, so they stopped the bleeding, built up the capital fortress. But this wasn't just about playing defense. What was that first really big, aggressive move they made to change their structure and grab market share?
That takes us to the biggest headline move, definitely. They saw what they called a tremendous opportunity, and they jumped on it, combining their global wealth management business with Citigroup's Smith Barney unit. That was the big offensive play.
And this new giant, Morgan Stanley Smith Barney. Crucially, MS was in control operationally. What kind of scale are we talking about?
Oh, overnight, they just became the leader in wealth management. No question. The scale was just immense. Over 20,000 financial advisors managing, get this, $1.4 trillion in client assets.
1.4 trillion. That's a massive buffer.
Right?
Stable, fee-based income while the institutional trading side was still navigating chaos. But you mentioned it helped the institutional securities business too. How?
Right. Beyond just the stable fees and sheer size, it gave them much better distribution for their institutional products.
Enhanced distribution capacity. Okay, break that down. What does that mean for, say, an investment banker working on a new fund?
It means basically if Morgan Stanley's institutional side cooked up a new product, maybe a special bond fund or some equity derivative, they now had this built-in sales force of 20,000 advisors ready to offer it directly to wealthy clients.
Ah, synergy.
Exactly. It connected the dots. Turned that stability from wealth management into sales power for the whole firm. They weren't just buying scale. They were integrating how they made money.
And it's worth pointing out, the piece Morgan Stanley brought to the table wasn't exactly struggling. Their own global wealth management unit, even before the deal, was doing well in 2008. What are the numbers again?
Yeah, they were strong. Pre-tax income of $1.2 billion, I think.
Yeah.
And a really impressive 48% return on average common equity for 2008. Plus, they brought in $35 billion in net new assets.
So a solid foundation for that mega merger. Okay, let's pivot now to the institutional side, the engine room. Despite all the chaos, they turned a profit there too in 2008. $1.7 billion net income. Where did that actually come from? And just as importantly, where are they pulling back?
Yeah, it's pretty amazing they made money at all, given the environment. They actually hit record full-year results in a few specific areas, commodities, foreign exchange, and equity sales and trading, including derivatives. These are the flow businesses, moving assets for clients. They can actually benefit from volatility if you manage the risk well.
And it wasn't just trading. Their advisory business held up too, right? I mean, the U.S. government called them for help with Fannie, Freddie, AIG.
That's right. It shows that in a crisis, credibility counts, maybe even more. They were advising on huge global deals, even while the financial world felt like it was ending. But that success also sharpened their focus going forward. It became, okay, only put capital where we lead and where the risk-adjusted returns make sense.
Which sounds like they took a scalpel to their existing businesses. The letter says they were exiting or cutting back higher risk and balance sheet intensive businesses. They named names, didn't they?
They did, very explicitly. They were getting out of those areas that soaked up capital and carried big risk. Specifically, proprietary trading, betting the firm's own money. Also, principal investments, those longer-term illiquid bets. And residential mortgage origination, obviously toxic at the time. They were consciously shutting down the businesses that required them to take big directional risks with their own capital.
So if that's what they were cutting, where did the capital go towards?
It flowed back towards those high-volume, client-focused businesses, the ones benefiting from flow. So flow trading, equity derivatives, foreign exchange, interest rates, and commodities. It was a really fast, deliberate shift in where they placed their bets away from big directional gambles towards facilitating client transactions.
Doing all this required some serious cost-cutting, too. The letter mentions a $2 billion reduction target from the previous year. Logistically, how do you even do that in the middle of a crisis without just stopping everything?
Well, it's incredibly hard. It takes a massive commitment across the entire firm, top to bottom,
Right.
and a real shift in thinking about risk. Probably the most powerful signal of that shift was what they did with compensation.
Right, the clawback. That was a big deal at the time.
Huge. Morgan Stanley was the first big U.S. bank to bring in a clawback provision for deferred bonuses. This wasn't just about saving money. It was about changing behavior, fundamentally. It meant if losses down the road could be linked back to risky decisions made now, that deferred pay could actually be taken back.
Wow.
Yeah, it tied bankers' paychecks directly to the long-term health of the firm, not just short-term profits. Real alignment.
That does set a precedent for accountability. Okay, let's wrap up with asset management. That division actually lost money, a $1.8 billion pre-tax loss.
Yeah, that was a brutal number. But again, management didn't just hit a check on the whole division. That loss mainly came from those legacy principal investments we mentioned, those illiquid internal bets on things like real estate or private equity, stuff they basically had to write down and clear out. Painful, but necessary.
But the letter says they still saw asset management as critical, a high-return business for the long haul. So even while taking those hits, what were they doing to rebuild it?
They focused on the areas they could control and grow. Even then, They put energy into growing their alternatives group, seeding new products clients actually wanted. And the best example, probably, was expanding their infrastructure business. They closed the Morgan Stanley Infrastructure Partners Fund with $4.6 billion in commitments.
And crucially, that $4 billion was more than their original $2.5 billion target. So even with losses piling up elsewhere, they were still successfully raising money and investing in areas with long-term potential. They didn't let the crisis kill the future plans.
Exactly. That's the core message from the letter, I think. It's this dual track, defense and offense at the same time. Cut the bad stuff, legacy assets, costs. While simultaneously making these huge aggressive moves, the Smith-Barney deal, the MUFG alliance, to gain market share and solidify capital, they really use the crisis itself as leverage for change.
So wrapping it all up, John Mack, the CEO then, said it was the toughest market he'd seen in 40 years on Wall Street. Just absolute chaos. And yet, Morgan Stanley's whole strategy seemed to be about staying, quote, nimble and moving fast to grab opportunities. They didn't wait for things to calm down. They moved first to create their own stability.
Which really leaves us, and you, the listener, with the fascinating question, doesn't it? When you look at these incredibly fast, aggressive moves Morgan Stanley made, I mean, pulling off a merger, creating a $1.4 trillion asset manager during the crisis, totally changing the risk profile, what is the right balance between being cautious, which is necessary, and being opportunistically aggressive when everything around you feels like it's collapsing? When do you pull back? When do you actually lean in and pounce?
That's a great thought to chew on, thinking about how you navigate your own challenges, whether they're financial or something else entirely. Thanks for diving deep with us today.